The story of the day, of course, and of the past week has been rise of US bond yields. The benchmark 10-year bond yield has surged to 4.85% on Tuesday after the JOLTS or the job openings data showed much higher job vacancies than expected. Latha is here with her editor's take on the rising US yields. Latha, what's happening here?
Well, yes, 16-year highs for US yields. We have not seen 4.85% on the 10-year benchmark bond since July of 2007. And it is the measure for the world. It's the cost of capital for the world. And that's why we keep tracking the 10-year. The immediate trigger for the jump overnight was the JOLTS data, as they call it, which is the job openings data. The vacancies announced in August were 9.6 million. And the street's estimate was that it would have come at 8.8 million. So that's a substantial, almost 10% higher than what the street was expecting for. But this is only the immediate trigger. The yields are up about 100 basis points over the quarter itself. July, August, September, they've risen a lot. And for that, there are many reasons. First, there is this fear of one more hike, especially after the last FOMC meet. There is very much that fear which Jerome Powell himself expressed. As well, if you remember, the Fed dot plot had made it very clear that the number of cuts are going to be 50 basis fewer than what the market was prepared for and what the previous dot plot had said. So the fear of rates staying higher for longer is very much there because of the dot plot, exacerbated by the dot plot. Other big reason for why you're seeing the yields rise is this fear of a large supply of treasuries coming from the Fed. You know, the US fiscal deficit is expected to double this year to $2 trillion from $1 trillion last year. Month after month, when the data comes out, bond markets are shocked by the amount of supply, amount of deficit run by the US government, and that has to be filled only by borrowing from the market. Besides this, there is a paucity of buyers. First and foremost is the Fed itself. The Fed used to buy in past occasions because of quantitative easing. Now, because of quantitative tightening, they are actually selling off the existing balance sheet. They're tightening their balance sheet. In the past 1 year, they've tightened it by $1 trillion. And every month, they're tightening it by $65 billion. That's their said given timetable. The other big buyer who is absent are the Japanese funds, because Japan's yields in the country are at 10-year highs. So Japanese investors want to buy their own bonds for the same, for the returns they give. And that is another very big buyer who is absent. And finally, treasuries all over the world are buying less of US bonds, especially after Russia's reserves were suddenly de-recognized by the US. There is a bit of a trepidation in all countries that we shouldn't plant too much of our reserves in US bonds. Let's go to gold. Let's go to other currencies. So for a whole host of reasons, buyers have shrunk. Issuances are looking like they're going to increase. And therefore, one has to look for also, what is the near-term trigger for it to bring it down. It looks like the momentum is so strong, experts tell us that from 4.855% is a very short step. They expect the 10-year yield to go to 5%. But there are some quarters who expect that before the non-farm payroll data comes out on October 6th, there is a chance that there will be a correction. What if that data is weak? And therefore, some kind of advanced correction may come in. And thereafter, it will very much depend on, good news will be bad news. Whenever there is strong data, you're likely to see the yield move up.
All right.
Impact on India, of course, that will keep RBI, announcing a tight policy on Friday.
All right, Latha, so many repercussions of how the money market, the bond market is really developing, and we'll have to keep an eye on this very developing factor for a long time because it has its impact on the global equity markets as well. Let's also hear out